Does the Fed rig the bond market? That's what this article here in the Wall Street Journal by Lawrence Goodman says, how the Fed rigs the bond market. Sales by vigilantes used to serve as a warning of inflationary policies. That signal has been muted. My name is Emil Kalinowski. This is Eurodollar University. We're all joined by Jeff Snider, the head of global research for Alhambra Partners. Jeff, I believe this article was inspired by your appearance with our friend Eric Townsend. He's so kind to mention me. You know, you guys do a whole show, and at the very end, he says, like, you guys are doing a good job, and Emil's on the show. That was very kind of him. It was the best, that podcast, ladies and gentlemen, if you haven't heard it, that was the best blood sport podcast battle I've seen since Jean-Claude Van Damme went to South Korea and battled that South Korean guy. Remember that in Bloodsport, 1989? Jeff, tell us what happened. And because there was one moment where Eric said, the bond market, can you rely on it?
Yeah, and I think that's really what most people say, or at least they're conditioned to say, is that when you say bond yields are low, therefore growth and inflation expectations just aren't there, they immediately scoff and say, well, no, bond yields are low because the Fed is buying bonds and the Fed controls interest rates, and the mechanism for controlling interest rates is QE. So how can you possibly say the bond market doesn't see growth and inflation? Because the bond market is nothing more than the plaything of Jay Powell and the FOMC. So forget this bond market crap. The Fed has got rates low, and so we're going to dismiss that signal because it's so inconvenient to our thesis, and we've been crying about inflation for year after year after year. And it never happens. So, you know, how dare you, bond market, disagree? You must be the Fed's plaything, otherwise our idea is just crap.
You know, the bond market, I understand where people are coming from. I'm going to explain why that is. You explain as well that it makes sense. But how come we never hear about Eurodollar futures or the US dollar, the two other markets that are the biggest in the world, a complex system of humans providing multiple independent opinions about the direction of the global economy? The US dollar, Eurodollar futures corroborate what US Treasury markets are saying. And we never hear about how that's being manipulated.
Exactly. You know, and this is a point you raise all the time, Emil, and I'm glad you do it because it's before we even start about the, QE and bond yields, it's not just bond yields. That's why when we talk about the bond market, we use quotation marks because the bond market isn't just US Treasuries. It's everything. There's all sorts of very sophisticated, very deep and liquid markets that are incorporated into this fixed income structure, this monetary structure globally. That it's not just treasuries, it's all sorts of things. As you just mentioned, Eurodollar futures is one, which is very much corroborated. As you point out all the time, I don't see any Eurodollar futures positions on the Fed's balance sheet anywhere. Interest rate swap spreads, interest rate swaps, those prices, the Fed's not in that market either. The US dollars exchange value, a very simple one, which is a measure of monetary tightness, which would go along with the message being sent by low interest rates if they're not being controlled by the Fed's QE, which is, the Fed isn't buying all of these other things, as well as, as we see in data of like TIC or the People's Bank of China's balance sheet. Is the Fed and the People's Bank of China balance sheet clandestinely conspiring to rig treasury markets or, the influence of US dollar markets so that we're not generating a genuine signal in these places? Of course not. What really happens is that the bond market provides a very inconvenient signal because it is so historically validated to people who have been forecasting and crying and predicting about runaway inflation for so long. They need a very easy shorthand that the public that believes is very plausible to dismiss what is otherwise a very straightforward contrary indication.
In episode 166, if I remember correctly, ladies and gentlemen, I read the BIS bulletin number 48, where they do a nice short brief review of supply chains and the upstream and downstream effects and how they believe that is what is affecting these consumer price surges. So it's a good article for you to listen to and then check out in the show notes when it comes to why prices are high. So Jeff and I believe. Okay, here, quote, where am I getting this, by the way? I'm getting this from a post on the 18th of November, 2021 at the Alhambra Investments blog. The title is, "No, the Fed does not rig the bond market. and it only takes 5 seconds to debunk the myth. You're not allowed to curse and do expletives, but I feel it was coming. It was coming. Okay, quote. And on the surface, central bank bond buying does sound like it could possibly spoil the message. After all, some all-powerful government agency is going to be, buying bonds at prices that have nothing whatsoever to do with any sort of fundamentals. It will take them, purchase them by the bucket load at whatever price. So how can it not keep prices artificially high, therefore yields artificially low? Jeff, we're going to be going chart by chart now, but just very quickly, we're going to be focusing on the US. And do we have Europe in here too?
Yes.
Okay.
No, that's where we start, right? Because whenever you bring up this idea, that's what people will say. Well, the Fed is buying bonds, so how can it not be affecting the price? But that's where everybody leaves it. It's like we just accept the fact that bond buying must affect the price, or that central bank bond buying must affect the price, because that's what everybody says. And it sounds like it should be what's happening. But as we know all too well, theory and practice are usually very different things. So in theory, this sounds very simple, but everybody just leaves it at the theoretical level. They never say, okay, let's validate the theory and see how it worked out in actual practice. And as I said in the title of the article, and you were right, there were a couple expletives that wanted to come out in it, because this is such a huge, frustrating pet peeve of mine. It only takes 5 seconds to disabuse you of all of these notions. The central bank does buy bonds, but it also does not have any effect. And we can show this to you in absolute crystal clear visual representation, as well as any number of scholarship and literature pieces you want to look up written by the central bankers themselves. But again, you just look at a chart. Look at a chart and you'll know that in theory it sounds great, but in practice it's something else entirely. In fact, it's exactly the opposite.
How about this? We can say, yes, government actions do affect bond prices. Yes, they make them higher. But how much? Is it the whole thing? Is it the whole kit and caboodle? No. And on the anniversary of QE, the 20th anniversary of QE, we reviewed a meta study, which I don't know how many different studies are represented, but it found that the median impact on bond yields was 50 basis points, about, right? Not even. They said about 50 basis points
they didn't give us the confidence range either. I'm sure it was plus or minus a bunch too.
For every 10% of GDP, 10%. You get 50 basis points, maybe. So, a little
even
bit.
If you take that at face value, Emil, right? Starting where we are now. So let's add 50 basis points to the US 10-year Treasury. What does that get us? Barely 2%. How is that inflationary? How is that the Fed erasing this inflationary message? So even if we assume that study is anywhere close to accurate, and again, this is a meta study of other studies that central bankers have written, and these central bankers authors are looking for positive effects from QE and unable to find it. So even if we say, yes, okay, central banks lower long-term yields by 50 basis points, it still doesn't change the situation one iota. It still says that interest rates are incredibly historically low. And so they're not being held down by QE, they're being held historically low by something else. But even I'm not that. Maybe you're a little bit more optimistic about QE than I am. I look at all these charts and I say, if you can find a tangible effect, a singular effect from QE, I don't know where you see it, because more often than not, it's up and down and all over the place. So the best that you can say is that there really doesn't seem to be any relationship between the Fed's bond buying and bond yields. But moreover, whenever these things stop, bond prices tend to go up, because the situation calls for higher values and higher use and utility of safe and liquid instruments. So in my mind, during the bond buying programs, there's not much of a straightforward effect at all. And then when there's not bond buying, bond prices tend to be up higher than not. So at the very least, not much effect, and more likely, it's kind of the opposite.
Ladies and gentlemen, rewind 30 seconds, re-listen to what Jeff just said, and now we are going to put into pictures what he was saying. And we're going to start in 2008 through 2011, and we're looking at a chart here, Jeff. What do we see? We see US Treasury securities held by the Federal Reserve, and we see the US 10-year yield and the 30-year yield. Now, in 2008, the Federal Reserve is not going out there and cannonballing into a kiddie pool and knocking all the water out and throwing its weight around. They're not doing any of that. And yet, bond yields are falling. Then they do take off their floaties, they take off their swim cap, and they dive in and they go cowabunga, and they buy the bucket. All the water is thrown out of the pool, and yields are rising. It's the opposite.
Rising.
It's totally the opposite.
How are bond prices going down with the Federal Reserve buying bonds, right? That's not what the theory says. The theory says the Fed controls interest rates, and here we have a prime example during the very first QE where the market behaves, as you pointed out, opposite of what it's supposed to. So not a good start here.
Okay, we're moving forward. We're entering into 2010. The Federal Reserve is not buying anymore. Okay, they're stable. Bond prices are, what are they doing? They're rising. Federal Reserve is not buying anything. Bond prices are accelerating upwards. Okay, then the Federal Reserve says we've got to start saving the system, QE2. We're going to start buying by the bucketful.
Before you get into that, let's talk about that. Why did the Fed get into QE2, and what did the bond yields after QE1 actually tell us? So bond yields that were sinking, actually they were collapsing after the end of QE1, were a deflationary signal. Undisturbed by the fact that the Fed had just bought all of those bonds. It amounted to hundreds of billions of US Treasuries into the summer portfolio. That's not what caused bonds to rise after QE1 was over. It was the fact that in early 2010, we had all of these alarming liquidity signals all over the world when we had just experienced the great global financial crisis, and we're told that this liquidity tsunami by the Fed and other central banks had fixed it. And so we had all of these bad signs, especially in repo and collateral in early 2010, that were deflationary, lack of growth, lack of opportunity, high demand for safe and liquid. That's what drives interest rates, not the Fed's bond buying. And here we have a very perfect example in QE1, right off the bat in the United States experience of it, which shows the Fed doesn't have any influence on bond yields. What does is reality, the real monetary system, real economic potential. And it was that low, what was causing bond yields to sink in early 2010, the deflationary outgrowth of late 2009, that actually convinced the Fed in the summer of 2010 they needed to do QE again.
We're moving forward, 2011, and now the Fed has stepped in again. So they're buying like maniacs. What should bond prices be doing when the biggest whale out there, Big Mama, the US version, is in there buying everything? Well, bond prices should be surging upward. But they didn't. They went the other way. Bond prices started falling.
For the second time.
You couldn't give them away.
Exactly. The Fed starts buying bonds and the market starts selling them, which is not how it's supposed to go. It's the exact opposite. And then, as you get to the other part of that chart, the Fed stops buying bonds, and what happens to bond prices? Bond prices go through the roof after QE2 is over. Yields absolutely plummet after QE2 is over.
No more buying. Prices surge. No, that huge buying gravity absent, and yet we're seeing as if there was some other force, some other planetary body that had a greater gravitational pull.
Well, let's explain what's going on here. I mean, we've got two very good examples, and they'll continue and get through them. But what is really going on here? If you think bond buying and the central bank means everything, you are utterly confused. This makes no sense to you, which is why, as we talked about in the beginning, people always leave it at the theory and never go back and check and see if the theory is valid, because this doesn't make any sense. The bond market is behaving exactly the opposite the way it should act. But when you realize that the central bank and its bond buying doesn't really matter, and that Irving Fisher was right over a century ago that long-term bond yields are nothing more than growth and inflation expectations, it actually makes perfect sense. Bond yields started to rise in the early parts of each of these QE programs because the market was saying, maybe it'll work. Maybe this time the Fed has hit upon the magic number and this will work. And so growth and inflation expectations rise because the market seems to think, well, maybe QE1 didn't work, but maybe QE2 will. And so that will lead to better growth and inflation expectations. The nominal yields rise, but they didn't rise all that much. So the bond market retained a good bit of skepticism, which very quickly was validated because after the Fed's bond buying program is over, the market says nothing really has changed. In fact, it looks like we're going into another dollar problem, another collateral squeeze, whatever it is. And so I only want to own safe and liquid instruments, which is the other way of saying depressed longer run inflation and growth expectations. So it's not really a mystery at all. You just got to get yourself out of the mindset that central banks and their bond buying actually mean what it's supposed to mean. In fact, they don't mean very much at all.
What happens between 2012 and 2016, Jeff? We're talking about QE3 mortgage-backed securities and QE4 US Treasury securities. And I see, Jeff, tell me if I've got it right, that heading into 2013, we had yields falling, so bond prices rising, even though the activity by the Fed was minimal to nothing.
Yeah, there was Operation Twist, but who cares about Operation Twist? Not even the Fed cared.
And then we see a surge in buying by the Federal Reserve, a huge increase, and bond prices should now be rising because the Fed is so important. It's central. It is the sun of our monetary universe. Instead, we see the opposite. And then we start into the third Eurodollar. But did I get that right before we talk about Eurodollar number 3?
Yeah, once again, you see yields gently rise as the Fed is buying bonds, which is supposed to bring yields down. And then the taper celebration in May of 2013, when yields actually moved much higher, which we just explained was the market saying, you know what, this tapering stuff, maybe there's a reason behind it. Maybe growth and inflation expectations are rising. And so not only the yield curve shape, the nominal yields rose in tandem with why Ben Bernanke at that time was tapering his bond purchases. But interestingly enough, the very moment or only a couple of weeks after the Fed actually began to taper, which was December of 2013, so the Fed is buying fewer bonds. They're still buying bonds, but they're buying bonds at a reduced pace. All of a sudden, bond prices start to go up again. So the Fed buying fewer bonds, bond prices going up, yields falling. So that's the opposite. And then after QE4 was terminated in late 2013, bond prices went up even more. Yields fell. Yields actually plummeted again as they had in 2011 and 2012. So again, at best, there's mixed results when in reality, when you put it all together, the bond market doesn't behave at all in the way it's supposed to. In fact, it behaves more likely its opposite or it contradicting the theory in practice.
And the bond market was reacting to emerging markets experiencing their version of the European sovereign debt crisis and their version of the mortgage-backed security, quote unquote, contained 2008 crisis that the United States did. That was then happening in 2014 and 16. So that's why bond prices were rising, yields were falling. And now we're heading into what? I have to turn an extra page. Here we go. Now we're turning into present day. No, now globally synchronized growth, Jeff.
Yeah,
2017.
Let's talk about QT.
Yes.
If QE is supposed to heavily influence bond prices in one direction, QT, which is the opposite of QT, should heavily influence bond prices in the exact opposite direction, right? If the Fed isn't just, the Fed has stopped buying bonds and is actually reducing its bond holding in its own portfolio, bond prices should be tanking, right? They would be plummeting. Not only is the Fed not buying, the Fed is not really selling, but they're no longer reinvesting either. And remember, 2018 was the Tax Cut and Jobs Act, which too many treasuries, the deficit exploding. So, it was horrible time to be a treasury market investor, right? Because prices were going to just plummet through the floor.
That's what the textbook says, but not the graph we're looking at.
No, if we actually look at what happened, bond yields rose before we got to QT, globally synchronized growth, higher growth and inflation expectations. And then once QT began, at best, they kind of went sideways to slightly higher, which was somewhat consistent with the theory, but not really considering, too many treasuries, deficits, all of those things, plus QT. And then November of 2018, while QT was still ongoing, while the federal government was still exploding its deficit, all of a sudden, bond yields plummet. Bond prices go through the roof, even though Uncle Federal Reserve is not there to save its ass, because once again, we see The Federal Reserve and its balance sheet is largely immaterial to what goes on in long-term bond yields, which are driven by growth and inflation expectations, which were globally synchronized growth in 2017, early 2018, maybe a slightly higher probability for growth and inflation after the middle of 2018, and especially November 2018. No, we got less growth and inflation expectations as globally synchronized growth had already turned into a globally synchronized downturn, if not recession in many parts of the world. So again, bond yields don't react to the Fed, they react to that growth and inflation expectation.
Jeff, if I remember correctly, about half our audience is from outside of the United States. And we want to talk about the rest of the world. We don't have enough time to go country by country, but we do have a couple of graphs here showing Europe. Is there any difference, or is the same story being repeated in Europe?
Yeah, I included the European experience, specifically German bonds being bought by the ECB, just to show, just to prove, to establish beyond any reasonable doubt or any honest doubt that this is not a US phenomenon. It is a QE phenomenon. It is a bond market phenomenon. It's consistent across jurisdictions, as well as time periods, as well as every single factor and dimension with quantitative easing. Bond yields are not influenced by the Federal Reserve, which, if you're honest enough, the Federal Reserve actually tells you, as does a lot of academic scholarship, as we talked about in the beginning, but you don't need all that. Just get out a chart and you can see for yourself how the theory is nothing like practice.
At the end of part 2, we stepped away from the United States, and we're going to continue that journey. In part 3, we're going to look at China, Germany, and Japan, what their economic accounts are telling us, not just about those countries, but for the whole global economy.